Here is a question worth sitting with on Wednesday, the 29th of July, 2026. If the money in your account never sleeps, why does the institution holding it still clock off at 5? That is essentially the argument senior Morgan Stanley executives made in comments reported today by CoinDesk. Their claim is blunt. The traditional 9 to 5 banking day is officially dying. This is not a forecast about some distant decade. It is a description of what has already happened underneath us. Bitcoin and Ether have traded every hour of every day since the moment they launched. Stablecoin transfers clear at 3 in the morning on a Sunday without asking anyone's permission. Meanwhile, the plumbing of traditional finance, the wire cutoffs, the settlement windows, the overnight batch processing, still runs on a timetable designed for a physical trading floor with an opening bell and a closing bell. To understand why this argument lands now, look at how uneven the system has become. In Britain, faster payments launched back in 2008 and has moved retail money around the clock ever since. The United States only caught up in July 2023, when the Federal Reserve switched on FedNow for instant transfers on any day of the year. Yet sitting alongside those always on rails are legacy processes that stop dead. SHAPS, the UK's high-value payment system, still has a daily cutoff in the late afternoon. Corporate treasury teams still plan around end-of-day sweeps. Reconciliation still happens overnight, in a batch, because that is when the systems were designed to be quiet. So we now have a financial system with two speeds running side by side, consumer payments that never stop, and institutional infrastructure that still assumes everyone goes home. Morgan Stanley's point is that this gap is no longer sustainable. Several things shifted quickly. Settlement got faster. The United States moved its equity market to T+1 settlement on the 28th of May, 2024, having the time between a trade and the actual exchange of cash and shares. The UK and the European Union have committed to the same move on the 11th of October, 2027. Faster settlement leaves far less slack in the day, which forces post-trade teams to work closer to real time. At the same time, exchanges started attacking the trading window itself. In November 2024, the Securities and Exchange Commission approved the 24x National Exchange, designed to trade for close to 23 hours a day. Nasdaq has publicly set out plans to extend to 24-hour trading across the weekday. The New York Stock Exchange has proposed lengthening its own ARCA session substantially. The trading day is being stretched from both ends until it meets itself. The second driver is regulation catching up with digital assets. In the United States, the Genius Act was signed into law on the 18th of July, 2025, creating a federal framework for payment stablecoins. That single change turned an unregulated corner of crypto into something a large bank could touch without career risk. Tokenized funds moved in the same direction. BlackRock launched its tokenized treasury fund BUIDL in March 2024, and Franklin Templeton has run an on-chain money market fund for several years. These are instruments that can, in principle, be transferred and redeemed outside banking hours. Morgan Stanley itself is not observing from the sidelines. Its E-Trade platform has been preparing to offer crypto trading to retail clients, which means a wirehouse with trillions in client assets is stepping onto rails that never close. Once your own products trade at the weekend, defending a 9 to 5 operating model becomes very difficult. Start with the customer. In the UK, more than 6,000 bank branches have closed since 2015, so the physical 9 to 5 counter is already a memory for most households. What replaced it is an app that expects an answer at any hour. If you can move money at midnight, you also expect a fraud block to be lifted at midnight, and that is exactly where the pressure shows. Contact centers, fraud teams, and financial crime staff are increasingly working rotas that look more like a hospital ward than a bank. For businesses, the change is sharper. A finance director who once knew precisely when cash would land now deals with counterparties settling stablecoin payments on a Saturday. That changes how much idle cash you need to park on a Friday afternoon, and it changes when errors get discovered. Round-the-clock money means round-the-clock responsibility. There is a serious cost to always-on finance, and it deserves honest treatment. Liquidity is not evenly spread across 24 hours. Overnight and weekend sessions are thin, spreads widen, and a modest order can move a price far more than it would at midday. Crypto has demonstrated this repeatedly, with some of its most violent moves landing at weekends when traditional hedging markets are shut and nobody can offset a position. Extending equity hours risks importing that fragility into mainstream markets. There is also the engineering problem. A system that never closes has no maintenance window. UK regulators have already tightened here, requiring firms to demonstrate by the 31st of March, 2025 that they can stay within defined impact tolerances for important business services. Running 7 days a week with no quiet period makes that promise considerably harder and considerably more expensive to keep. The realistic near-term picture is not an overnight jump to a 7-day banking week. It is a staged retreat from the fixed day. Expect 24-hour trading across weekdays to arrive before genuine weekend trading, because weekday extension does not require rebuilding clearing and settlement calendars. Expect more banks to issue deposit tokens and tokenized funds, giving institutional clients a way to move value outside standard hours without waiting for the wholesale system to modernize. Expect staffing models to change before technology does, with follow-the-sun operations spread across time zones so a London desk hands over rather than shuts down. And watch the UK timetable closely, because the October 2027 shift to T+1 settlement is the point at which British post-trade operations lose most of their remaining breathing room. The direction is consistent even where the pace is uncertain. So what should you actually do with this? The single most useful takeaway is that the 9-to-5 banking day was never a law of nature. It was a convenience built around human working hours and paper settlement, and both of those constraints have gone. When Morgan Stanley executives say it is dying, they are not making a cultural observation, they are describing a competitive problem. Institutions that can only act between 9 and 5 will keep losing business to venues that never close. For you as a customer or investor, the practical implication is simple. Check when your provider actually processes transfers rather than when it claims to be open. Be cautious about trading in thin overnight sessions where prices move on very little volume. And assume that over the next few years, the question will stop being when the bank opens, and start being whether it ever closes at all.